traders that were forced to become investors because their day trade turned into a swing trade and then into a position trade. And then now we're recording. So Dave Hunter is with us today. I always look forward to talking to David. You can follow him on X at Dave H. Contrarian. And Dave, we had a red wave. And, they say elections have consequences. So, how does this fit into your narrative? I do want to congratulate you on your forecast. It's unfolding as you said it would. And the election gave it a little bit of a boost here. So, talk to me about what you think is going to happen once Trump takes office or what you think the effects are going to be of this red wave.
Sure. First, great to see you, Dale.
You
Haven't
too,
talked to you in
buddy.
a little while. I think it's a good time for us to have a conversation. Yeah, I think the election was important. Obviously, last week's action in the markets told you the markets liked it. I obviously he doesn't take office for a couple months, but he's certainly hitting the ground running. My sense is that he learned a lot in his first 4-year term and is doing things very differently this time, knows who he can trust, knows who to surround himself with. And I think that's going to make a big difference over the next 4 years in terms of getting policy implemented. And as you know, in the 2016 term, he got quite a bit done even then. So I'm optimistic that we're going to see, some real pro-capitalism, shrink government type of policy going forward, and that should cheer the markets at least for the next few months. My view of last week we had a 300-point pop in the S&P.
Right.
I think it would not surprise me to give back half of that this week. So we still have a few days left in the week. So it shouldn't surprise anybody if we get back towards 5,800. Might not go that far, but there's a little gap, I think, just below 5,800.
Yes, we gapped up that day
Yeah,
on the election day.
Right. Yeah, so if we want to fill that, it wouldn't surprise me, or it might not get that far, but basically take back half. And then I think it's clear running here. I think we are in that final. What I've talked about for a long time is that as we approach the end, we would go into a parabolic. I think we're probably last week was the beginning of that parabolic. And so that means you're going to have a pretty fast sprint here to what now is a 7,500 target for me. I think the S&P can get 7,500, the NASDAQ to 25,000. Those are recent increases. I went from 7 to 7,500 in my fourth quarter letter, and from 24 to 25,000 on NASDAQ. My Dow target is 55,000. My Russell target is 3,300, and I didn't change those. So I think we've got basically between 25% and 40% upside here, and you could see it in the next few months. So that's what I call vertical.
Okay, so that is going to be compressed. In fact, I was going to ask you, since we've almost gotten to your target that you held for a year or two before you saw something in your cycles to give you higher upside projections. Do you want to revise it down to 61 here? It doesn't sound like it. I'll let you have 61 back, and you can say mission accomplished, right?
Yeah, we learned.
Just like the Fed. The Fed was saying mission accomplished when they cut by half a point. So
yeah, I was going to say we learned from George Bush that we probably shouldn't say mission accomplished.
Yeah,
So,
you get jinxed on that one for sure.
Yep. But I'm very comfortable. I consider my 7,500 number a high conviction number. So as far as it sounds crazy to have these kind of runs, but we're in an unusual period, and I think it's, as I've said many times, it's the end of a 42-year secular bull market that started in August of 1982.
I was short IBM that day. at the bottom, so here I was sure I
Yep.
remember that day and I talk about it. And, I bring this up to people that haven't been around as long as you and me, is that this is not a young bull market. It's 42 years old, going on 43. That in your work, that's a pretty long-term secular bull market, isn't it? It's not young,
Yeah,
it's
we
age.
haven't. I don't think we've seen too many bull markets like this going back in history. I don't have my history all the way back, but certainly, this is as long as any cycle I've seen, and it's we had plenty of cyclical bulls and bears within that secular bull, but that's a long run. And I use 1982. Some people quibble with that as the start. I use it because that was really the start of the disinflationary trend that pushed this
Yeah.
market up. The PE multiples were single digit then. PE multiples now are in 22, I think around 22.
Yes,
Uh,
660 Dow
yep,
in August of 82.
yep.
Just to put it in
Yeah, I don't.
perspective.
I was thinking it was 780 at the bottom. I
Oh,
might be wrong,
maybe.
but yeah,
Yeah, maybe I'm
I
thinking
think
about
the
the Haynes bottom in S&Ps.
yeah, that's right. 660 in
Yeah.
2009. Yep.
Okay. So, I wanted to ask you about your cycle, because cycle, like you just said, it's about time. All cycles are about time. So, it doesn't matter to me when a market reaches a target or objective, whether it's, everyone would like it to happen today. Everyone likes immediate gratification, but the timing of hitting a target is not as important as hitting the target, right?
Yeah,
So, are
I
you,
go
go
ahead.
ahead.
No, you
Well,
go ahead.
the question was a long way around it is, are you surprised at how long this has taken? Because we were talking melt ups for a year or two, and there were times, well, I think we'll be done in the summer, then I think we'll be done in the fall. And your best guesstimate now is you think that we're going to be pretty close to done by Inauguration Day.
Yeah, I don't know if I can call it that closely for sure,
Yeah.
but yeah, I think first of all, my work is not really time cycle at all. I know there are people out there that do 4-year cycles, 8-year cycles, and all kinds of cycles.
Yeah.
None of my when I say cycles, I'm referring to basically the market cycle that ties in with the economic cycle,
Okay.
and so it's really not time at all. Um, I make the mistake, obviously, of trying to guess how fast we can get to a top.
Yeah.
But it's really
That's
driven.
tough.
And the reason I kept putting it out there as, it could be within 6 months was to talk about that once you go into the parabolic, you can cover an awful lot of ground in a hurry. The problem was we hadn't gotten, each of those times it looked like we could start the parabolic. It was part of the melt up, but it really hadn't gone into the parabolic stage. I believe we are in that stage now, which means you can cover 25 or 30% in 2 or 3 months. And that sounds crazy. And it doesn't have to do that. It can stretch out even again. And I don't know that inauguration day is important, but I do think it's probably, first quarter and maybe earlier in the first quarter. But on Twitter, I get myself in trouble. All the criticism is about, they say I'm wrong because I put out these possibilities of time, but it really is the targets that are important. The market's going to determine when we get there, and it's not. And again, it's not. I'm not playing a game of saying I'm going to put the target out there that's unlimited in terms of time, but it can stretch out if you have consolidations. That just stretches out the time until you get there. But I think we are, if I'm right, we are in the parabolic stage now. We're just beginning it, and that means it's going to stay in this steep run with as I say, you can have 1 to 3% pullbacks at any time, but I don't think you're going to have 5 and 10% pullbacks that stretch the cycle out.
Okay. It is not unprecedented for new presidents after they're sworn in, or here's Trump is almost like a new president because he skipped a term where the financial crisis is dumped, that they're tested early on in their administration. That happened with Bush with the dot-com bubble. He was tested. Obama was tested with the financial crisis. Uh, right on his desk when he entered office, TARP was under Obama. So it is possible that Trump is tested
Yeah,
early as well.
yeah. Not only tested, but it behooves a an administration to. It's kind of like when a company has a new CEO come in, they tend to throw the kitchen sink into their into the earnings, so that you have a terrible quarter or two, and then they have clear sailing. For a new administration, it behooves them to get kind of crank down if you're worried about inflation or other things, and so that the last 3 years you have the wind at your back. So it's pretty common to have the first year be a tough year for a new administration. I'm not sure. I don't think Trump's trying to engineer anything that way, but I do think if you're going to take on government efficiency and you're going to see $2 trillion taken out of the government or anything close to that, that certainly can have a dampening effect on the economy short term. It'll be very positive longer term, but it could have a dampening effect short term. Obviously, deporting millions of people will have possibly a short term dampening effect. You'll have a
We're going to pay
positive.
$10 for an avocado, Dave.
I don't think inflation is our risk here in the
I'm just
short
talking
term.
about labor.
Oh, labor, yeah,
That's not going to
yeah.
want to
There's
go out there.
there's going to
And
be there's going to be plenty of migratory workers. There's going to be plenty of green cards. I think,
okay,
hopefully, and I would presume Congress and the president understand this. If we're gonna finally put this to bed and bring back our sovereignty and secure our borders, we also have to do um, very important immigration reform, and we need workers. Our demographics say we need workers,
yeah.
but instead of taking the people at the bottom that may not have skills and take people out of prisons and stuff like that, let's do immigration reform where we encourage those that want to come here to work and not come here to get on the welfare rolls. That's the difference. Is we need, Congress kicked that down the road so many times.
Yes,
um,
both parties.
yeah, we need both parties. We need reform, and if you have control of Congress, and I know it's not large majorities, you should be able to do real reform this time, and we need that. So it's not anti-immigration; it's anti-open borders, is what is changing here.
Okay. So I'm trying to come up with a scenario that would light the fuse to continue the melt up after any pullback. And my thoughts immediately come to yields. Okay, so I wanted to ask you, Dave, when the Fed cut by a half, I was expecting, a sell the rumor, buy the fact, maybe a rally back to 4%, maybe 4.10. But the persistence of rates here, what could light up the market would be at least a yield softening again back towards 4%. Have you ever seen the beginning of an easing cycle and a pretty big cut at the beginning end up with it being in the Fed's face like this ever in your career?
Yeah, I don't remember, but I don't really track that. What I would say, because that's more trading, short-term stuff, and I don't remember. But what I would say is, we have to remember the rates, back in spring were 470. They came down to
Yeah,
360. I mean,
yeah,
you had a 110 basis point move,
right.
and so a backup. I thought we could back up certainly to 4.25. The backup to 440 is a little surprising, but not a big deal. I think all this is a counter trend. It also fed into, there was a lot of, I think, what I call misinformation out there, but there's a lot out there that I think is very lousy analysis on what Trump policies mean for the deficit, for inflation, et cetera. I think they're very wrong. As you know, most of the economic community, and especially the Ivy League economic community, hates supply side economics. If you look back and over, cutting tax rates across the board raises all ships. It does raise revenues. It's the problem we've had is a profligate spending. We haven't had a problem when you cut taxes that revenues go down. So I believe that they're going to obviously extend the Trump tax cuts, but they're probably, and then you hear all these other things. I don't know what he'll get, but no tax on Social Security recipients, no tax on tips, et cetera, et cetera. I don't view that as the deficit's
It's
going
going to
through the
get
roof.
done.
I think you're
Yeah.
going to get I think you're going to see a very strong economy once we get through the bust, which is probably from second half 26 on. I think what they're going to do in terms of reducing government and some of the other things are going to help us. There's problems. There's big macro problems we're going to be facing, but I think at least the Trump policies will soften some of those blows.
Okay. Well, the move in rates certainly has not hurt the market. But the action in this chart itself is a better dig in heels. We had this very nice rally from last spring, but it's given up about 70% already. So
I get myself in trouble with short term, making anything but longer
you
term
still
calls.
think
But
120 is possible?
yes,
Um,
I think so, and I think we're turning. I think we're turning as we speak, or I think we're very close to a turn here. I don't think we're going to see 5% by any means. I think 440, 445 is about it, and I think you're going to see possibly 120 in the first quarter, and that
well,
translates
that'll be
to
risk off, won't it, Dave?
well,
Uh,
no, I don't think so. I think basically that's risk. I think you're going to see it. The recognition is that the economy is decelerating, inflation is still in good shape and ultimately decelerating, and that's going to spur it. It's not people running to the bond market to get out of stocks. I think stocks and bonds are going to run together here.
okay.
Um, to that 120. I don't know whether it's 120 or 125 or 110. But I think you've got the potential for a 2.5% 10-year in the first quarter. That
Well,
would be
this is your biggest contrarian trade right here, Dave.
yep.
Uh, and it could and it could be putting in see the left shoulder.
Yeah, it's an inverted head and shoulder. I think it is.
Yeah, break out over 100. That
Yep.
gives you 120. Now I see your case.
So and then that's not the end of the bond market because beyond the melt up, I'm still in the camp that says we're going to have a global bust, something I define as worse than 2008 and 9. I see the 10-year going to zero, which means
Okay.
the like
New all-time highs in
TL,
TLT.
TLT can go to 200.
Okay. The other fly in the ointment, which is yield related, is the dollar.
Yep.
And so, we almost broke down at 100. See, I do a lot of dollar trading. Look at all.
Yeah.
Look,
Yeah.
look, I better put my crayons away. Anyway, it looks like the dollar's trying to break out of this range here. So I'm thinking if they're to have the catalyst for the numbers you're talking about, we need the dollar to turn back down, and it still might have some more upside left in maybe 108, and yields to turn down, and that would be the jet fuel to get to above 7,000.
Yeah, and I very much think the dollar is very close to rollover.
Okay.
Could be any day. And I do my dollar target, which was 80, I've raised it to 82 just from a trend standpoint. But I think you can fall that far. So 106
Wow.
to 82. And I think the yen will be strong. Euro will be strong. I have a 130 on the euro versus the dollar.
Okay.
So I'm thinking you are about to see. That's what I think drives the parabolic is that kind of a move, and it's
In the
not
dollar.
gonna it's not gonna finish out right the same time as the stock market. But I think in the next 6 to 8 months, the dollar can go down to 82.
Okay. So that's another contrarian trade.
Yep.
You have plenty of company on being bullish at stock market. You don't have a lot of company right now being bearish. Well, Ray Dalio, I guess, is a pretty good company. Or
On
anyway, yeah, if we get through 100, your targets are very achievable. Um, so why don't we talk about gold? Now, gold almost got to your target. You were looking for 3,000 during
Yep,
the melt up, and we got what to about 2,800, Dave?
yep.
So is this a break to buy? I was thinking we might see 2,400 first.
This is why I said today is a good day, because I think yields, rates, the dollar, gold, silver. I think they're all at their inflection points, and I believe the dollar. I raised my gold price to 3,400. I can't remember when I did that. Maybe back in July, I can't remember, but it was sometime in the last several months. Um,
Okay.
so I think it's going to 3,400 from here. And I think we just had a correction. I hear a lot of talk about 2,400.
Do
I
you?
don't,
Okay.
yeah, I don't think we're going back down there.
Okay.
I think this is a trend line. It's a not the main trend line, but it's a trend line. From back in February, you connect the dots there, and you're pretty much down on that trend line. So,
Okay.
um,
All right. So we're still holding an uptrend in your view, and silver, have you raised your targets from over 50? Because when gold was almost at targets, silver wasn't close to
right,
50. It got to
right.
35. So
Yeah,
are
my
you
target, my
raising the targets there?
yep, my target on silver is up to 75.
Okay. So
So I
where's that going to put the gold silver ratio around
I think it takes
60?
it down to 45, maybe.
Okay. Yeah, so we had this big plunge and we're fighting our way back. So you're right, we are at inflection points
Yep.
where markets could reverse what they've been seeing here as of late.
Yeah, and
Uh,
I see it in the sentiment on Twitter and elsewhere.
People are
Everybody's
turning bearish,
they're
gold
turning
and
bearish on the
silver.
metals. They're ready to throw metal and silver out forever. And
Yeah,
I have to remind them that silver's moved on, it basically doubled from a couple of years ago, and yet to hear the talk, you'd think it was still down at its bottom.
yeah, we're yeah,
Silver
yeah.
was $17 back in September of 22, I think.
You know why? Because they didn't buy silver, they bought the shares. That's my
Yeah,
guess.
well, that's part of it is the miners. Yeah, the miners are very
The
disappointing. And
Very disappointing. I mean, best of breed, Newmont
yep,
got killed. GDX got killed. Would you avoid the miners? I know you liked a long time ago, liked SILJ, the junior
yeah. No,
miners here.
I'm super bullish on the miners. I think
All right.
it's been a choppy start, but they look very good. I think GDXJ can get to 100, probably 100 plus. SILJ, which is junior silver, can get to mid 30s. And again, I think those are minimum targets, not
Th-
unrealistic targets.
those are melt up targets.
Yeah, they are, and I think silver and gold and the miners probably trade beyond the top in the stock market. They could go on for a few months after that. So everybody wants everything to top out at the same time. That's not reality in the markets, as you know. So I think because they're coming from farther back, I think they've got a longer runway.
Okay. There is some pretty ugly technical action in some of the global markets. I know you cover U.S. markets, but all the money flow, I mean, is towards the U.S. because of elections have consequences. Europe looks weak with what's happening in Germany and France, and China still has its own problems. Um, any ideas, David? I know you probably think about it. You've given me an answer before that what's going to cause the top is just exhaustion
I think
of the market.
the top in the market, the actual, reversal in the market could just come out of exhaustion. But the ultimate bust that's coming, as I use a simple equation, which is economic fragility brought on by the pandemic. I still think when you look below the surface, the pandemic
Yeah.
caused a lot of things to be more fragile, particularly small business, but a lot of things in our economy, not only here, but particularly in Europe and Asia. It's a lot more fragile than it was in previous entering into the end of previous cycles. Then you add to that the leverage, and leverage is probably the biggest key. You've got 320 trillion of global debt, and you've got quadrillions in notional value of derivatives. The debt's leverage on the economic system and the financial system. The derivatives are leverage on the markets. They're going to bring you huge volatility when we run into trouble. So that's what I think is the bust comes from, and it's triggered by, I think, um, a monetary policy mistake. Typically, is what triggers this stuff. Which means, again, the Fed is the one we watch. It's pretty much mirrored around the world. But look at it. I mean, everybody's concerned that the Fed eased too much. You shouldn't have done 50 basis points. Look at the economy; it's fine. If you look below the surface, a guy like Dave Rosenberg, I think, would support this.
Yeah.
If you look below the surface, this economy is not in good shape at all. The government's been boosted to, I think, probably to help the election for Kamala, but and before that Biden. But ultimately, I think that's kind of phony growth. That the private economy is really not in great shape, and yes, the consumer is still in one of those things where, yeah, housing prices are up, my equity's up, I still have a job, so I'm going to keep spending. But if you look, I call it the have and have not economy. Half the country is barely getting by. They're worried
Yeah.
about putting food on their table.
Yeah, they're using cards
Yep.
and they're getting starting to get cut off from their cards.
Yep.
Yeah, and I think, Dave, that you've been great to the upside. Okay. I think that your clarion call is going to be so critical when this thing ends and rolls over because U.S. households have never been longer U.S. stocks as a percentage of their assets. And boomers have 75% in stocks right
Yep.
now.
Yep.
And they will not have time to recover if we get the kind of bear market you're anticipating after a few more months of doing cartwheels.
Yeah, that's what I keep saying. It's a real paradox. On the one hand, I tell people that we're very close to the end when you look at 42 years and you're down to the last few months, maybe. Um, but the runway between now and the end is basically what you would normally take 2 years to get.
Yeah,
40% in the Russell is 2 years worth of returns, maybe, or certainly 18 months. So, so even though it may all come in the next few months, I caution people, you're near the end, and don't think you're going to be smart enough to get out at the top. On the other hand, know yourself, because people who, and there's plenty of institutions like this too, hedge funds in particular, people who have gotten out in the last few months, have missed this run. I know psychology very well. That's my, behavioral economics is really what is the backbone of what I do. Um, People who get out early are going to be forced back in because the market's going to be so powerful at the end. They're going to, and the narrative that's going to accompany that is going to be, this thing has legs. This thing's going to
yeah.
run for the next 2 years.
It's different this time.
Actually, listen to Ed Yardeni. He's already started
Yeah,
that narrative.
yeah,
So what I think is the paradox is that people have to understand time is short to the end, and nobody's gonna ring a bell. On the other hand, if you can't stay away from the crowd, you're going to be in at the top because you missed it now. You're going to feel compelled to get in later. If you're in now, you can then be a little more say, well, I'm not worried about the last 10%. I'm getting out now. But if you get out prematurely, you're probably going to be coming back in with the last 10%.
yeah.
So it's a real tricky thing.
Okay.
More than anything else, though, people need to understand that if I'm right, this thing ends in an 80% bear market. And so it's not about, well, I can buy and hold and I'm going to be, in a little bit of pain for a year. No, this thing will be devastating for those that don't get out.
Yeah, the baby boomers that don't have time. And you brought up Rosenberg. I caught him before the election, and at that time he said he was a nervous bond bull, and if there was a red wave, he was going to take the bull out of the sentence.
Yeah.
So he
But
may,
that is part of what I keep saying is that I
yeah,
think the narrative that has driven the bond market to where it is a wrong narrative. It's everybody is so convinced that Trump's policies are number one inflationary, but worse than that, very bad for the deficit. And I think they're wrong. I get it. The whole economic empire is built around this idea that supply side doesn't work. I'm a big believer that you cut taxes, you give incentives, and you lift the economy. And it's nonsense. This idea that we need people look at the marginal tax rate instead of looking at overall tax revenues. It's not about cutting marginal tax rates is not negative for the deficit because it raises revenues.
okay. Can you say that tariffs are positive? There were people alive in the 30s that would disagree with you.
Yeah, well, it depends on how how they're instituted, how much, exactly what. I step back here and say,
It's a tax.
well, yeah, but let's remember, Trump's a negotiator. Trump, he's putting forth
Yeah,
his first offer. His first offer is not going to be where you end up.
yeah.
So yeah, he's going to talk about dire tariffs because he's trying to bring people to the table and get them to be reasonable. He is right, though. I think that we are a country, and again, I blame the economics community. I grew up in as you did you, and
The Rust Belt.
everybody since that believe that comparative economics is the way to go. That you give away all your stuff to the countries that can do it cheaper, and you'll be a stronger economy for it. We gutted our industrial
Yeah.
base. That's what Trump's going to begin to restore, and he's right to say you can't do it marginally. You can't do it at the margin. You really have to do something pretty dramatic to get that to turn around, or else you're just going to constantly be falling behind the eight ball. So
Well, I
I
hope we have time because the manufacturing base for almost everything we use is still in China. It would take 6 months to replace a transformer on our grid because they're all mainly manufactured in China.
yeah,
We don't
well,
make any here.
think it's going to be a very different world, and I've said this for a number of years. The cycle, because we will have a recovery cycle after the bust. The cycle after the bust is going to be driven by industry, by industrial, rather than consumer. We've spent, basically our careers, or certainly since 1982, in a consumer-driven
Right.
economy where it was all about disinflation and the consumer spending. The consumer, number one, will be flat on his back coming out of a bust if we get an 80% bear market and real estate down 30 or 40%. And but if we're reshoring in a dramatic fashion, if he really does do some things with tariffs, you're going to see, we started it with semiconductors, but you're going to see it across the board with steel industry, with lots of things where it's going to come back here. And it's not all going to be, China's going to lose some of that business.
Okay. Well, you know what, Dave? I think that no matter what team you were rooting for, that it's time to root for the success of who won the election because his success is our success.
Yeah, I think it is important that people understand, you still see lots of TDS out there, but it's important to understand that basically this is a pro-capitalism policy that he's pushing, and we really need to stay on that focus, not all the other extraneous stuff that people want to throw out there to try to undermine him.
All right. Well, I thought I'd wrap it with since you were talking about parabolic.
Yeah, well,
Now, I actually think Bitcoin is going to be an indication of when the blow off is over
yeah,
because it's a poster child.
I have, as you well know, I have sworn off Bitcoin from the beginning,
Yeah.
and said I want to see how it does in the bust. That's to me, and I still say this. To me, Bitcoin is an instant, has no significance to the macro, and I'm a macro forecaster, a macro strategist. So I can beg off of it because there's no macro significance at this point. But I've also said that's not a commentary on whether it's going up or down.
Yeah.
I'm not trying to make recommendations. So
It's part of the
obviously
speculative bubble, Dave,
it is,
that we're in, right?
and one of the reasons I never wanted to get there is because it's a very hyped market by a lot of it by former hedge fund guys that failed in
Yeah.
equities and ran over here. So
Yeah.
I
What a think those people are.
yeah. Yeah, but there's one more market I think we need to talk about, and that's oil.
Oh, I knew you'd bring it. Okay. So uh just in Bitcoin for people to watch, this formation was 60,000. This is either the handle of a cup or a big bull flag. 60,000 from here measures 126.
Yeah,
So,
I wouldn't quibble with that.
yeah. All right. So let's talk about oil. And do you differentiate oil and natural gas because of policies coming in here? Because nat gas has shown a heartbeat.
Yeah,
It's trying to come out of here. But
not next.
here's
Yeah,
your oil.
yeah, not next cycle, because next cycle I think all commodities are going to go through the roof, and
Okay.
you could see 30 or 40 or $50 nat gas. So
Okay.
I'm calling for $500 oil at the end of the decade or early next decade. So I think they'll both be flying after the bust. But going into the bust, what I've said is I don't really forecast nat gas this cycle because there is a glut, and number two, it's very weather related, so I can't do short term on it. Between now and the end of the melt up, I couldn't tell you where it's going. Um, but but oil, I do feel I've had a $60 number there, and I do feel we're headed there this year maybe,
Yeah.
and it could even undercut 60, and then in the bust, which between now and late this next year or early 2026, I think oil can get down to 30.
Okay.
So,
That'd be a
and then if you go
breakdown.
from 30 to 500, you obviously know where we're going in inflation. So,
Okay. All right. Well, Dave, great catching up with you. I think we covered the board. Anything that we missed that you could think of?
no, other than I would say, spreads are still saying that, the corporate bonds, junk bonds, et cetera, are still behaving. I think they'll play right into the melt up as well. After the melt up, it's treasuries, or the only thing in bonds you want to be near at that point is treasuries, because the spreads are going to explode in the bust, I think. So
And the dollar and the
uh,
dollar.
and the dollar, I think, will have a big bid up to maybe even 120 or higher, because, and it won't be early in the bust, but as it becomes more apparent that this thing's big, I think there's going to be a huge flight to safety, and we'll still get that. So I think, yeah, it's going to be a very volatile period where dollar goes down to 82 and then back up to 120.
Okay. So great catching up. Dave H. Contrarian. And the H is for you'll be a hero if you get people out before the bust.
Yeah, maybe, or I'll have to change my middle name and it'll be Dave G.
For for what? Gee, goat?
Garbage.
Goat, greatest of all time. All right. Well, David Hunter, thanks so much for being here. Let's catch up, you know, Jan, Feb, and when we're getting closer to it, or if you think you are, let me know and we'll get you on here to keep people informed because the melt up is nice, but being able to preserve capital is really going to be very important.
Yeah, I agree.
All
Okay, yeah,
right.
that's
All right.
great. Hey, thanks for having me on. Great to see you again. Happy Thanksgiving and Merry Christmas.
Same to you. David Hunter, the most bullish bear on the street. Thanks for being with us, buddy.
See you there.
All right, that's a wrap. Take it easy. Thank you, David.
Yeah, you're welcome. This will be out later today, right?
Yeah.
Okay, great.
All right.
Okay.